Welcome back to Chai with Siddick, your weekly market wrap for NRIs investing from the Gulf. 9% in 5 days. That's not a wobble, that's a war pausing. Brent crude fell off a cliff this week, and we'll get into exactly why. Every single index we track is green this week, and somehow that's the least interesting part of today's episode. Markets were kind to us, the noise around them wasn't. Korea crashed 39%. Korea is also 53% this year. Both are true. Only one of them is useful. Stay until end. Today we are putting three of scariest headlines in market right now on India, on Korea, on AI, up against the actual numbers. Grab your chai. Let's go. Good week across the board on the equity side. S&P 500 up about 1%. Nasdaq 100 basically flat, up half a percent. The real strength was back home. Nifty 50 up close to 2.5%. Sensex up nearly 2.75%. The rupee also had a strong week, gaining just over 1% against the dollar. And then there's oil. Brent crude down over 9% this week. That's not a typo and it's not noise. That's one is real and it's exactly where we are headed next. Here's what happened. On Monday this week, the US paused its strike on Iran, and Iran signaled it will hold off on retaliating as long as that pause holds. That's real de escalation, even if a fragile one. And oil traders reacted instantly. Brent dropped close to 9% in a single day, one of its biggest one day falls in months. For us watching from the Gulf, this isn't just a headline. Oil ripples through everything here: government spending, job markets, real estate. A calmer Middle East, even a cautiously calmer one, is good news for the region we actually live in. Okay, now let's get into the real reason I wanted to make this episode. Every single week, there's some new headline built to scare you out of your portfolio. Not because it's true, because fear gets clicks and it works, because half of it does sound true. So today, three examples: India, Korea, and AI. Let's separate what's real from what's just noise. I need to say this plainly because it's costing people money. The idea that India has given zero returns is one of the laziest pieces of analysis floating around finance YouTube right now. And it frustrates me because I have seen NRIs actually pull money out of their SIPs over this exact narrative. Here's the trick: take the worst 2 year window you can find, ignore everything before it, put it next to a US chart, done. Instant panic, instant narrative, and conveniently, instant reason to move your money somewhere else. Except nobody invests for 2 years. You invest for 5, 10, 20. So let's look at the number that actually matters. Yes, a plain Nifty 50 index fund has had a brutal stretch, down 6% this year, down 3% over 1 year. I'm not hiding that from you because I don't do that here. But zoom out: 8% a year over 3 years, 10% over 5, almost 12% over 10. That's not a dead market. That's a market that had a bad year, like every market on earth has, including the one they are telling you to run to. And here's what the India is finished crowd never mentions: nobody serious builds an Indian portfolio out of a plain index fund. Active funds have beaten it, not narrowly, by a mile, category after category. Mid caps, 8.5% this past year, close to 18 a year over 3. Small caps, nearly 10% this year alone. Even boring old large cap funds are beating the index comfortably, and that's before we even talk about sector funds. For example, pharma alone is up over 16% this year. So tell me, does that sound like a market with zero returns, or does it sound like someone cherry picked a chart to sell you fear? Currency risk is real. Global diversification is smart if you can do it. Do both. But don't let anyone scare you out of a market that's still compounding just because 2 years made for a dramatic thumbnail. If you disagree with me, genuinely tell me why in the comments. I would rather you push back with your own numbers than nod along with and forget this in 5 minutes. Remember, 2 years isn't a strategy, it's a headline. Next one, Korea. If you have seen the headlines, you know the story. Korea crashes. World's best market falls into bear territory. Numbers like 38, 39% getting thrown around. And here's the thing, that part it isn't even wrong. Korea's KOSPI really did fall close to 40% from its June peak. Genuinely brutal. I'm not going to pretend otherwise. But here's what almost nobody puts in the same headline. Even after the crash, Korea is still up around 53% this year, up around 109% over the last 12 months. Read that again. A 40% crash, and the market is still up over 50% for the year. Both of those facts are true at the same time. The crash is real, the gains are also real. The only question is which one someone wants you to hear, because market crashes 40% gets 10 times the views, market up 50% even after a scary correction. This is what I mean when I say don't just hear the noise, ask what happened before the noise started. Remember, a 40% crash sounds terrifying. Coming after a 109% gain, it sounds like gravity. Last one, probably the noisiest topic in market right now. AI is crashing. The bubble popped. You have heard it. Let's actually check. Three ETFs I keep an eye on. All Ireland domiciled, so relevant for us here in the Gulf, covering semiconductors and AI more broadly. SMH, AIAI, and IUIT. Between June and July, all three did fall. SMH down 25%, AIAI down 14%, IUIT down 13%. Real drawdown, no argument there. But look at the bigger window. SEMH is still up 45% this year, 90% over the past year, over 300% across 5 years. AIAI up 30% this year, 54 over 1 year. IUIT up 14% this year, 23 over 1 year. A sharp pullback after a run like that isn't a crash, it's gravity doing its job. Now, am I telling you AI stocks won't fall further from here? I have no idea. Truly, I don't know, and neither does anyone shouting on your timeline. Nobody knows. It's not in our control, and we don't need to know. What we do need is a portfolio balanced enough to survive whatever happens next, up, down, or sideways. And I'll say this plainly because it matters. If you find yourself jumping from one hot narrative to the next, chasing whatever is trending this month, all you are doing is funding somebody else's cause or community. That's the business model. Fear and excitement sold back to you as insight. Remember, an opinion on where the market goes next is at best a coin flip wearing a suit. Here's why all three of this matters specifically for us. Sitting here in the Gulf, we are bombarded with global headlines all day. Indian news, Korean news, US tech news, all of it competing for a reaction. It's easy to feel like you need to do something every time a headline screams at you. You don't. Your salary lands every month. Your SIP should too, regardless of what Korea, India, or AI headlines are doing that particular week. That's the week. Green across the board. Oil down nearly 9% on real de-escalation news. And three of the loudest headline in markets right now checked against the actual data. If any of this made you think or made you want to argue with me, good. That's the point. Drop it in the comments. Agree or disagree. I read everyone. If this was useful, hit subscribe. It genuinely helps a small channel like this one. Same time next week.